Welcome to the deep dive. You know, Charlie Munger famously said, "All I want to know is where I'm going to die, so I'll never go there." It's a wonderfully provocative way to think about navigating uncertainty.
Especially in finance, right?
Exactly, particularly in financial markets.
Yeah.
It's really about knowing the risks, understanding those pitfalls, and, well, actively trying to avoid them.
Yeah, steering clear.
And that's pretty much our mission for you today. We're diving deep into the Capital Alphabet 2023 annual letter. It's a really fascinating document from a portfolio manager, and we're going to pull out the most important bits of knowledge and insight.
The key takeaways.
Right. So by the end, you should have a clear understanding of their, let's say, unique long-term investment philosophy, how it actually played out in a specific year, like 2023, and what practical lessons we can maybe learn about managing money when the market's always changing.
Sounds good.
Okay, with that in mind, let's jump right into Capital Alphabet's core philosophy. The letter kicks off by acknowledging, the Goldilocks economic environment of 2023.
Yeah, quite a year.
A year where the NASDAQ just soared, up 43%, mostly thanks to the Magnificent Seven. NVIDIA alone contributed 11%. Yet the manager flat out says they don't forecast the general market.
Right. That's not their game.
So if they're not chasing headlines or trying to predict the market, what is their main goal?
Well, what stands out immediately is their long-term view. Their stated aim, their whole purpose, is to consistently beat comparable indexes over the long haul.
Okay, long term.
But here's the really crucial twist. They fully expect, even plan, to significantly outperform when markets are flat or going down, and perform just okay, maybe even slightly below average when markets are booming. Which, raises a key question for anyone looking at them. How do they actually define superior performance?
That's where it gets really interesting, I think. They give a clear example. They'd see a 15% drop when the average market is down 30%, at a far superior result.
Right. Much better than just rising 20% when everyone else is too.
Exactly. It's not about being the top performer every single quarter, not at all.
Precisely.
Yeah.
And this connects to a bigger idea. It's basically about accepting that good years and bad years, well, they're inevitable. You have to focus on a resilient strategy underneath it all.
Instead of getting swept up.
Right, rather than getting carried away by short-term market highs or lows. For them, protecting capital when others are losing it, that gives a much stronger foundation for future growth, for compounding.
So, okay, how did this philosophy actually translate into results in 2023? That was their first full year running things.
Yeah.
They admit there were challenges, especially holdings in China and energy companies, but they still managed an almost 29% gain. How did that compare to the S&P 500?
Well, they actually did outperform the S&P 500's 26.19% gain for that year.
Okay, so slightly better in a big up year.
Yes, but what's maybe more telling is their cumulative return since they started back in June 2022. Capital Alphabet is up something like 67.43%.
Wow.
Compared to the S&P 500's 17.75% over that same period. That really speaks to their long-term focus, even with a pretty concentrated portfolio, just 5 to 10 stocks.
Which means volatility.
Which inherently means, yeah, some periods are going to be bumpier than holding a broad index.
Let's dive into some of the specifics then. You mentioned challenges. What were the bad news stocks?
The main ones dragging things down were energy companies. Gear Energy, Baytex Energy, Peyto.
Energy, yeah.
And the manager's admission here is quite candid, quite refreshing, really. He basically says he keeps forgetting that these commodity companies' fate relies on external factors, like oil and gas prices.
Hard lesson to learn or relearn.
It seems so. And this insight actually pushed them to question their strategy around investing in distressed situations, what they call workouts. They decided to pivot more towards just, good businesses. It really makes you think about the risks in those highly cyclical industries.
Definitely. But it wasn't all tough sledding. There were some big wins too, right?
Oh, absolutely. Meta was the star performer. Huge contribution, like 16.66% just from that one stock.
That's mad.
It is. And the manager has this funny line, anyone who preaches about efficient markets in the U.S. needs to take a good, hard look at Meta's stock roller coaster last year.
Fair point.
For them, getting in around $100 a share on a fantastic business used by billions daily felt like the easiest decision ever. And clearly, it paid off handsomely. Bank of America was another significant positive contributor, too.
This whole thing, this approach, it feels really personal. The manager keeps stressing, it's all about the long term.
Yeah.
How does their own commitment line up with their investors?
This is where it gets really compelling, I think. It's a true case of eating their own cooking, as they say.
That was it.
Well, the manager actually left a job at Bank of America specifically to focus on running these funds. He then rolled over his own 401k into an IRA and personally invested over $1 million right into the fund.
$1 million of his own money.
Yes. And he states his intention is to hold these positions for potentially 25 years until his own IRA distributions kick in. That level of direct alignment, putting your own significant capital on the line alongside your investors, that's pretty rare. It speaks volumes about conviction.
That's serious commitment. And I read they share a personal story that really hammers home this long-term idea.
They do, yeah. It's a great anecdote. Back in 2003, after a consulting trip, the manager took his savings, nearly $5,000,
Okay.
and invested it in a plot of land near what was just starting to become an IT hub in Hyderabad, India.
Ah, early days there.
Very early. And he just held on to that land for 20 years, through all the booms, the busts, political changes, everything. And the result, his first 50-bagger.
Wow, 50 times his money?
Exactly. And he says that experience really taught him the power of compounding and just how crucial it is to stay invested to ride out the storms.
That's a powerful lesson learned firsthand. So, wrapping this up, our deep dive into this capital alphabet letter, it really shows a clear focus on long-term value, right? A very specific philosophy for handling market ups and downs. And this profound personal commitment backing it all up.
Absolutely. And I think what this approach really underscores for you, the investor, is just how vital transparency is in money management.
Right.
Meaning ensuring that managers and investors are truly on the same page about the goals, how performance is measured, the time horizon involved. It's about finding partners, really, whose strategy and risk tolerance genuinely match your own.
Finding that alignment. Okay, so for you, listening in and looking to be well-informed, maybe the most thought-provoking idea to leave you with is this. If staying invested in a single, perhaps unconventional asset, like that plot of land for 2 decades, enduring all the booms, busts, and various political events, if that can lead to a 50-bagger, what does that suggest about the real power of patience, conviction, and maybe strategic capital preservation in reaching your own long-term financial goals? Something to think about.